Seemingly frustrated by a combination of poor supplies and focusing on the business opportunity now, Africa's richest man will pump $5 billion into quadrupling Nigeria's natural gas supply. And of course, by extension, power supplies should also be boosted quite a bit. We'll be looking at that in detail in just a moment. Welcome to Global Business Africa. I'm Raman Yang in the Kenyan capital, Nairobi. Here's what's coming up. Concerning Somalia, the channels for remittances are narrowed down drastically. And chefs and lovers of confectionery from around the world are in Algeria to sample that nation's growing chocolate produce. Now, Africa's richest man, Aliko Dangote, has announced plans to quadruple Nigeria's gas supply. To that end, he will be investing roughly $2.5 billion to build pipelines running from the nation's oil and gas producing Niger Delta region to the commercial hub of Lagos. Now, ideally, that should help increase power generation from gas in a country where power cuts are fairly common. 70% of Nigeria's power plants run on natural gas. Dangote is worth a reported $15 billion, and he plans to start laying the pipelines before the end of the year. The first of that lot should be operational by mid-2017. It says the world's two biggest private equity firms, the Carlyle Group and Blackstone, are also considering investing in that project. Still in Nigeria, the country's central bank is cracking down on non-performing loans in a bid to prevent a repeat of the nation's $4 billion bank bailout in 2009. Nigeria has been severely affected by the sharp decline in the global prices of its main export, crude oil. And that in turn has created a currency crisis that's not only strained government revenues, but it's also battered the cash flow of companies that have dollar-denominated loans. The CBN's latest directive orders banks to give bad debtors 3 months from the 1st of May to honor their debts and start servicing their loans again. Failure to do that will result in them being named and shamed in the local media and banned from local currency and government debt markets. Now, the central bank, however, did not give an estimate of the current level of non-performing loans.
The percentage we are going by, it's what we look at. 3.5% of over 13 trillion. It's not, in terms of lending, it's not the total bank size. The total industry size is far bigger than that. And secondly, 3.5% of these have been said to be bad. However, as bad as they are not that they are not recoverable. Some of them are, some percentage again within that 3.5% are recoverable, even though they are bad. Whether they are recoverable from the asset that have been used to collateralize them, or you need to go to the extent of taking extensive restructuring of the facility, particularly when the customer can demonstrate commitment to pay if certain things are done within the scope of their business that they are into. Or some people that have taken certain contracts and they have challenges in that contract. So it's not that when we say 3.5% of these are bad loans, it doesn't mean that they are entirely 3.5% irredeemable.
Now, this week we're focusing quite a bit on currencies. Yesterday we focused on the Egyptian pound and the Nigerian naira. Today's the turn of the Kenyan shilling. Off the back of fairly strong corporate dollar demand, the Kenyan shilling is still hovering around 3-year lows, at least it was on the 28th of April. In the year to date, the dollar has gained about 4 percentage points against the local unit. Now, while that's much better compared to sub-Saharan peers like the naira, Ghana's cedi, Kenya's enterprises and policymakers are still quite concerned. So then, are we just in a temporary dip in the local unit, or are we on the long road to a slow and steady depreciation? That's a question I put earlier in the day to the CEO of Rich Management, Ali Kansaju.
There is a seasonality around the shilling, and you're quite correct. At this time of year, the shilling tends to come under pressure. We tend to see an outflow of dividend payments, various estimates around $500 million going out of the country because so many companies in Kenya have a majority shareholder. Diageo is one in EABL, Vodafone is another at Safaricom. So you're quite correct, there is this seasonality effect. And also, you know, Rama, it's worth bearing in mind that if you're in any other capital city in sub-Saharan Africa, everybody would be asking, what on earth are we talking about? You know, look at the Zambian kwacha, the Ghana cedi, the South African rand. These currencies have practically fallen out of bed. So I think we need to contextualize the shilling. A little bit weaker, probably going to get weaker, but nothing on the scale of what we're seeing on other parts of the continent.
Indeed. Let me put you on the spot there then. How low can we go? Can you actually put a number on that?
So the target for the bears is surely 107, which was the record low that we saw print just over 3 years ago. But I think that was a really extreme situation when the markets lost a little bit of faith with monetary policy making and threw in the towel. But I think 95, 100 is possible if the dollar really starts to rally again hard in the second half of the year, which I think it will after the Fed raises interest rates, and it's irrelevant how much by.
Indeed, and of course the Federal Open Markets Committee is meeting right now. But let's get back to the question of the Central Bank of Kenya. The discount window rate is about 14.5%, has been for quite a while. Would it be fair to therefore argue that the lessons of 2011 have effectively been learned?
Yeah, absolutely. I think, I'm convinced that there is a lot of market respect for monetary policy making here in Kenya. There's a lot of predictability about it. I think our interest rates are high and handsome in a world where so many parts of the world have got negative interest rates. I think on the interest rate front, we're okay. Inflation well contained, monetary policy making, a lot of credibility around it. So I would say nothing to panic about right now, but definitely a weaker shilling is the trend, and the trend is your friend.
Indeed. Let's focus on the fundamental basis, however, here. Let's start with the crackdown on hawalas. Remittances, of course, have provided quite a bit of support in the long run to the Kenyan shilling. But given the crackdown we saw in the first half, or in the first quarter rather, of the year, isn't this essentially going to undermine the dollar shilling rate?
Rama, that's a very good point, and I think a lot of people have missed this. I estimate Somali money in Nairobi to be in the range of $3 to $6 billion, relatively liquid. And I think the government's response by a blanket response that I think it should be more forensic, has certainly made Somali businessmen nervous. And my concern is we've already seen some of this money exit. That informs us of some of the weakness of the shilling. And I certainly would say to the government, let's take a less of a scattergun approach. Let's be more targeted and make this community, not make this community feel that they are the target.
Indeed. Bolstering the argument, however, of a long-term decline, let's look at tourism as well. Tourist traffic incoming in 2014 down by 22%, about 800,000 or so people coming in. We're not seeing any fundamental security reform being done by the Kenyan government. Would it therefore be fair to argue that essentially Kenya's tourism, and by extension the dollar shilling rate, is in terminal decline?
It's a good point, and the weakness in the tourism sector, there is no silver bullet. It's not going to come back quick. It only comes back once we've had a period of stability. And that's not clear that we're going to get that, because the frequency of attacks has increased and the number of casualties per attack has increased. So if you look at it just from a statistical point of view, it's not looking too promising. But I would say, given that enormous cratering in the tourism sector, the shilling has held up quite well.
Part of my conversation earlier with the CEO of Rich Management, Ali Khan Sachu. Now, of course, you're still watching Global Business Africa from a very cold and wet and rainy Nairobi. But let's take you live to Lagos right now. Deji Badmus is live at the moment. We'll be focusing, of course, on the directive from the Central Bank of Nigeria a little earlier rather at the tail end of last week. Deji, this statement is fairly interesting. Banks, by default, are expected to manage their debt portfolios quite prudently. So what really prompted the Central Bank of Nigeria to issue this statement?
Well, first of all, Rama, just thank God you're not being beaten by the rain, that you're right now in the studio. But let me just go straight to your question. Now, what the CBN is actually doing in this case is just to, it's just being cautious to prevent what happened in 2009. Remember what happened in 2009 when banks in Nigeria actually went bust? So the CBN trying to make sure that doesn't happen. But of course, it has said this is not to say things are bad with the bank. It's come out to say, look, the banks are very good. They're in a very stable situation. As a matter of fact, the CBN actually conducted a stress test on the banks sometime in March and actually gave all the banks in Nigeria a clean bill of health, actually coming out to say, look, they have enough funds in their kitty to absorb any unexpected losses or unexpected situations. So what the CBN basically is doing is just to put banks on their toes and just to make sure they stick to that rules to ensure that their non-performing loans do not exceed the 5%, the laid down 5% that the CBN has actually given them.
Let's focus on some of the numbers here. Do we know exactly what gross non-performing loan levels are as a percentage of the overall portfolio at the moment?
Well, what we know is that as of April this year, it was 13 trillion naira. That's somewhere around $65 billion. And the percentage of non-performing loans of that amount now is just about 3.5% actually. And so that's one of the reasons some experts and even industry players have come out to say, look, it's nothing to worry about. 3.5% of 13 trillion naira or 65 billion naira isn't much. And then, as you heard in, one of the industry players actually said, one of the sound bites you actually took earlier on the program, this 3.5% is not as if the entire 3.5% are irredeemable loans. That quite a number, a significant number of that 3.5% are redeemable, and that these banks are working with these debtors now to recover these loans. So the situation is really not bad. And then they've come out to actually say, look, we should not make the mistake to think this is just in Nigeria only, that it happens everywhere. You would always have this kind of situation. But then the situation is not very bad at all. 3.5% of 13 trillion, not really bad. That's what they will tell you here, Rana.
But let's focus on the distribution of credit within the sectors, because it seems like we're in a bit of a deja vu situation over here. 2009, oil prices tanked. A lot of the loans that essentially went sour were linked to the oil and gas sector. Same thing has happened again this time around. Since lending to the solid mineral sector essentially dominated lending last year, is that a source of concern for the Central Bank of Nigeria?
Well, the Central Bank of Nigeria has actually not said that is basically the reason why it's come out to say to issue this directive. But there's no question at all. We all know that the oil industry is not doing very well. And whether we like it or not, a significant portion of the loans to these banks actually go to the oil industry. So, the central bank hasn't said that. And as I said, it's actually come out to say, look, the banks are doing well. That it actually conducted a stress test and that things are not as bad as people would think, that people should not be alarmed about this situation. But of course, you would expect that the bank would be bothered by the continued fall in global oil prices, and considering the fact that we're not having that huge investment in the Nigerian oil industry as we speak. But, well, the bank has basically not said, it's because of the situation in the oil industry. That's why it's actually come out to issue that directive.
Indeed. We'll leave it there for the time being. Thank you for your input. That's Teju Badmus live, of course, in Lagos, Nigeria. Let's move back to East Africa. Kenya, to be specific. The national carrier, Kenya Airways, could actually lift flight bans to Liberia and Sierra Leone. Those, as you might recall, we covered this story right here, were introduced during the region's Ebola outbreak in West Africa. Kenya's government says flight operations could resume in a fortnight after it was established that the two Ebola-ravaged countries have stabilized. The two nations are among the West African states absolutely battered by an Ebola epidemic that has killed an estimated 12,000 people so far. The epidemic affected airline operations in multiple countries flying to the affected nations. The Kenyan government also says a team of 170 volunteer health workers who were deployed to Liberia and Sierra Leone should be back home in about 6 weeks' time. Quick run through equity markets here for you. I'm afraid today I have a serving of red ink right across the board. Doesn't matter where you're looking at, the Nigerian market, South Africa, Egypt, even Kenya, the markets are firmly in the red. The construction industry in South Africa is yet again in the spotlight over collusion claims. And there's concern in Somalia's channels for lifeline remittances are narrowing drastically. Africa is on the move. It's home to 7 of the world's 10 fastest growing economies. We help you make sense of the fast changing African business landscape. We take you where the business is happening. Global Business, weekdays at this time on CCTV Africa.
Sustainable development and a commitment to developing partnerships with Africa. Some of the key phrases already used at the Africa Global Business Forum here in Dubai.
There is a need for a predictable environment in which investors have to put their money.
Welcome back to the program. 55 after the 57 prospective founding members of the Asian Infrastructure Investment Bank, except for Bangladesh and Nepal, have finished their fourth round of talks in Beijing. Now, the latest round of talks focused on the drafting of the AIIB's charter. China's Vice Finance Minister Xi Yaobin said earlier that the draft has been finished and members have reached agreement on several outstanding issues. Another meeting will be held before the end of May, with the charter being finalized and signed, hopefully, in June.
After being signed in June, the charter will be taken home by prospective founding members to go through the legal approval procedure. After a certain number of members agreed to or approved the charter, the AIIB can be established as a legal bank. We plan to finish this process before the end of 2015 and try to put the bank into operation by the year end.
South Africa's public protector now argues that the time has come to publicly name and shame people involved in collusive and corrupt activities in the private sector. Madam Tuli Madonsela made her case in Pretoria under the auspices of the country's Competition Commission. The Commission, of course, has found several companies guilty of collusive activities, cartel-like behavior and price fixing in the last 15 years. Angela Coppola found this report and reactions to the case made by the public protector.
As the public protector calls for naming and shaming for corrupt or collusive activities, businesses will suffer as investors may re-evaluate their strategies and look elsewhere, something that no country can afford.
Collusion and corruption both would figure in an assessment of investability and the desirability of making an investment in an industry or a geography. I suppose by definition they have to, because both collusion and corruption bring a number of industry impacts. Where a business is guilty of this type of practice, I think first it erodes the commercial attraction of the business, and second it compromises the ethics and governance and puts question marks over the sustainability of the business, which has to cause investment questions.
On a personal level though, naming and shaming is an option.
I've seen naming and shaming work very concretely. It worked in cartel work and it can work in corruption work, and it does work. It's a potentially very effective instrument.
That's after the fact. There's a suggestion that the problem is a deep-seated, structurally economic one.
There's an even bigger issue which doesn't seem to be played, and that is the importance of converting industries or transforming industries from oligopolistic structures to competitive structures, which in itself would discourage collusion and corruption.
To muddy the waters even further, there is personal culpability on corruption charges, but it's less clear when it comes to collusion.
Collusion and corruption are socially damaging and economically damaging. And it surprises me that this hasn't progressed, I suppose, to criminal status.
I think that collusion could be prosecuted under the Corruption Act, which is criminal and which does refer to individuals. Obviously the standard of proof is on a criminal standard, it's harder to prove, but sure, I mean, individuals need to be punished both for corruption and collusion, and that would send a much stronger message.
Corruption is a term that's generally associated with doing business in South Africa and other parts of the African continent. But the word collusion has started creeping into our terminology when it comes to doing business here. And some people see collusion as the lesser of two evils and would rather be found guilty of it than being found guilty of corruption. I'm Angelo Coppola for CCTV in Sandton, Johannesburg.
A little earlier in the bulletin, you had part of my conversation with Ali Kansachi concerning the ripple effects from Kenya's decision to essentially shut down hawalas. Now, remittance services to Somalia do make up a significant chunk of that country's annual income. Millions living overseas send money home to their families through that channel, and that vital lifeline has come under fire. First, banking institutions in the US and the UK stopped servicing hawala accounts, and now governments like Kenya's are essentially taking a sledgehammer to remittance services. Mohammed Hirmoge has the details on the effect of these decisions in What's Hot tonight.
The hawalas here work in a simple, customized way. Relatives abroad make deposits with transfer agencies. Then within minutes, the hawala subsidiaries credit recipients in Somalia. It's quick and relatively easy. Just prove identity and sign. But the hawalas, a critical lifeline in Somalia, have recently come under huge scrutiny.
I am very aware that at least 40% of the population depends on remittances for basic requirements, often for their medicines, for their schooling, for food and shelter. So I'm very clear that if that were to stop, the humanitarian impact on the country would be probably disastrous.
The United Nations estimates more than 4 million Somalis rely on remittance money to survive. Up to $1.3 billion is sent from abroad every year. That's more than any overseas development assistance or even foreign direct investment into Somalia. That support, though, has been threatened of late. Governments argue the hawala farms lacked controls to monitor where their money goes.
Over the last few months, there have been restrictions on the remittance services. There's suspicion that terrorists could also be receiving funds through them. What concerns us is that hawalas are a lifeline to our people. Suspending them will have huge impacts.
After years of conflict, few people in Somalia have jobs or bank accounts. Money from relatives overseas is the only way they can pay for food, medicine and education. But how long this lifeline can remain is a big question. Experts say closure or suspension of the hawalas will merely drive the remittance business underground, making it tougher for many people to support their families.
We're a family of 13, and the remittance we receive from abroad is our only source of income. Now, it's almost exam time, meaning all our outstanding fees must be paid. If we don't, then we will miss the semester, and I would be forced to wait until next semester to resit my exams.
If the hawalas remain closed, this support could be cut off. How her family would cope is a major worry. International banks and governments say the hawala farms could easily end up funding criminal activities. The local people say closure would be devastating. Mohammed Hirmoge, CCTV, Mogadishu.
Red ink is still very much a dominant theme as far as commodity prices are concerned, except, however, with the case of gold, which is up about 2/10 in trading earlier today, and cocoa, which is boosting quite the recovery, up by about 1 percentage point. Speaking of chocolate, chefs and lovers of confectionery from around the world are in Algeria to see what that country can produce. We'll have the details next.
To the world, it's a spectacular natural wonder. To Egypt, the River Nile means life itself.
These waters helped create an entire civilization. And the Nile has nurtured its people for thousands of years.
Following the Nile from the far south of Egypt out to the Mediterranean Sea.
Discover the sights, the stories, and the people of this incredible river.
Join CCTV for an unforgettable adventure.
The Nile, a journey of life, exclusive to CCTV.
Welcome back. We're 25 minutes into Global Business Africa. Now, chefs, confectionery brands, and those of us who like anything to do with chocolate, really, they gathered from around the world in Algeria to sample products from that country's growing chocolate market. The Chocolate and Confectionery Fair in the capital, Algiers, aims to promote traditional sweets and support local production.
These chocolate lovers are in heaven, surrounded by a myriad of sweet displays, culinary demonstrations, and even a chocolate fountain. The 4-day event features both Algerian chocolate makers and foreign chocolate brands, as well as local and international chefs from France and Belgium. It's the first time the fair has been held, and organizers say that's in response to Algeria's thriving chocolate market.
Algeria is the largest consumer of chocolate in the Maghreb. It is a market that is worth 150 million euros, meaning young Algerians have a sweet tooth. Through the exhibitors, they are led to discover all the new products. This Algerian market of 150 million euros is a potential one. According to Nielsen data from 2012, the market has been growing and growing. It's definitely not a shrinking market. On the contrary, so the Algerian chocolate market is a growing one.
The event aims to promote traditional Algerian sweets to the international market. Pastry chef Noël Amoui says the fair helps introduce visitors to traditional Algerian sweets.
The aim is to valorize Algerian products because we need people to know. So we make them savor and we can show them that we can ameliorate our traditional sweets and give them other forms and tastes.
And both international and locals don't need too much convincing.
I
find the traditional Algerian product very good. There's no difference with foreign chocolate. Our chocolate is so delicious and there are many brands. We have really evolved. I liked it. It's also original. I really liked the fair. Local chefs are proud of their products and believe they can compete on the world stage.
This is to show people that we have national products that we can use to make good chocolates. We don't systematically need to import or buy international products that cost too much and that not everybody can afford.
While foreign chocolate brands still hold the largest market share in Algeria, the local industry hopes events like this will see their products continue to grow in popularity. Maria Galang, CCTV.
Now, I don't know about you, but the only people who would benefit from a chocolate fest like that, at least in my perspective, would be my medical insurer and my dentist. But that's where we leave this edition of Global Business Africa. I like hearing what you think about what we do around here. Chocolate stories included. Global Business Africa at cctv.com is the email address to use. And of course, Facebook and Twitter. That's where you'll find all the news when we're not on the airwaves. Thank you for watching. See you in 23 hours. I'm Ramanyan.